Welcome to my channel. I'm Dr. Romano. Have you ever wondered why some hedge funds get so large and some don't? There's a lot behind this, and as you know, I'm Dr. Hedge Fund on YouTube, but I do have a PhD in financial management and leadership, and MBA in risk management and also in finance. And with my education and my experience and the research that I've conducted over these 8 years, I'm pretty much the person in the industry that analyzes why these things occur. And also, how do investors review and analyze hedge funds? I've done a lot of research at the PhD level. Those risk measures that the banks use are out of date in today's market based on my PhD research. Yet, they're still using a Sharpe ratio and other ratios and other traditional methodologies. Before we continue the video, please remember to do thumbs up, it's right there, and subscribe to my channel, please. I'm asking you to do that. It will really help me out. Thank you so much. You have to understand that today we have trades that are trading nanoseconds. Looking at a risk measure and trying to come up with whether or not you're going to select that hedge fund or not, it's very elementary. Secondly, the fact when you go to meet a hedge fund manager, you're basing your decisions, whether it's a yes or no, on that person's personality, because you didn't make up your mind prior to meeting that hedge fund manager. When you go to meet the trader of the company, which is the hedge fund manager, you should have already had in your head whether you're going to invest money or not. And this is very important, because just because some people are good sellers, like what Mark Cuban said, he said it was easy to make $1 billion, but it's very hard to keep it. And he also said if you have an idea and you're a good seller, then you will make a lot of money with that idea. And this is, again, Sam Bankman-Fried. He was also a seller because he was able to take his idea, creating a crypto fund, and he made whatever he made. It was a lot of money, and he was not even 25 when he started. And another thing, Ken Griffin was in his early 20s after he graduated from Harvard. He started Citadel. And also Ray Dalio, he also went to my school, which is Long Island University, and he started as soon as he graduated Long Island University, or possibly after his graduate degree at Harvard. And he started his company, which is Bridgewater. And what was really interesting is before he was doing Bridgewater, he was consulting people on interest rate risk. So when Ray Dalio says that the real estate market's going to go down by 50%, you know what? I believe him, because he was a trader back then. He was around at that time period. Again, it's very important to analyze that just because you may not like the hedge fund manager's personality, it doesn't necessarily mean that that person's going to be successful or not. It's your rapport with that person. Maybe it's blocked, or you have some memories of that type of personality that you don't get along with. So using the interview method of whether or not you're going to listen to that hedge fund manager speak about their strategy, about what they're doing, and putting in your own mind whether or not they're going to be successful is very elementary. That's not the way to do it. And because of my PhD, I reanalyzed all of these methodologies that investors use to select and deselect a hedge fund. And what I have noticed is that just because someone has billions or millions and they've been very successful in their career, they could have even been a portfolio manager, it doesn't mean that they're qualified to select and deselect a hedge fund for their portfolio. It means that they're using methodologies that everyone in the industry is using. And so when you think about that, what I just said, so in other words, all the investment banks collapsed at the same time in the 08 era. because they were all doing the same methodology. It was only Bank of America that got rid of those mortgages to the degree that they did, and that's how they survived. All the other banks, Merrill Lynch, Goldman Sachs, the two top banks to work for, they also went bankrupt. And of course, the government funded them, gave them the loan. They paid the government back, and also Warren Buffett bought shares in Goldman Sachs. So he saved Goldman Sachs. But the point of the story is that everyone at those companies, they're moving around to each company, and that's not talent. Ken Griffin has talent. Ray Dalio has talent. People who go on their own and see the idea and to improve whatever they do is talent. And so again, looking at a hedge fund manager's experience prior to opening their fund, that's another elementary methodology, because Ken Griffin, he didn't have experience before he opened his fund working for an investment bank. Ray Dalio did not have experience prior to opening up Bridgewater. So again, you are looking at the wrong indicators whether or not that hedge fund manager is going to be successful or not. And what I realize is that talent surpasses experience. Because you could have 20 years experience as a portfolio manager at a hedge fund or even a funds of funds, but does that say that you're qualified to produce superior returns for your clients? No, it doesn't. You see, when you're an employee at an investment bank or even a funds of funds or a hedge fund, you are facilitating the fraction of a 1% of what that company does and what that company wants. And you're doing what the company wants and what your coworkers doing and the coworkers before that, what they did. So experience does not give you the qualifications to run a funds of funds or a hedge fund. Now, of course, if you are someone that's a manager and you're managing a group, you do need experience for that, because you need experience on understanding the different personalities and how they get along with each other. And demanding that that person does this and does that, well, what if that wasn't the best fit for that job? What if that person wasn't the best fit for that task? Some people are good at certain things. And another thing is that looking at the manager's dominant quality when you are interviewing them on the first time, that's also an elementary methodology, because just because someone has dominant quality, that doesn't mean that they're going to be a good trader and a successful trader and have talent. There's many people out there that don't have that quality. Now, of course, if you want to sell a product, an idea, you actually need that dominant quality to propel that fund to 50 billion, 100 billion, such as Ken Griffin's company, such as Ray Dalio's company, and so forth. But you could also hire people to sell your fund and market your fund to investors. And so what type of person would you need? You need a person that's a salesperson that has that dominant quality to sell that product, which is the hedge fund investment or the funds of funds investment, etc. The only good thing about dominant people is that they're very good salespeople, and when they're working in management, let's say for an investment bank, they're good with getting rid of their competition, and that's all they are good at. Because they're not good at actually facilitating the job and the tasks, because they're going to dump that on everyone else, and they're going to create havoc and bad energy in the group, because other people in the group are not going to say what they're thinking to improve the group because they're afraid of them. And these people get ulcers, they quit. And so that's another problem with the dominant person as the leader of the group. They create really bad energy and a bad flow. You need someone that is a kind of like a coach. Someone has charisma, and they don't always have a dominant quality. So again, looking at the person's prior experience, Ray Dalio and Ken Griffin did not have prior experience. They went right to college, they opened up their fund immediately, and they started making money. and they started to advise people. And looking at whether or not they have a dominant quality is very elementary. Secondly, speaking to them and trying to get into your own mind whether or not that person is going to be successful, again, as I mentioned, is very elementary. And so now that I've discussed this, well, how do you select a hedge fund for your portfolio is the question. And that's why I completed a PhD. I was very unhappy with all the research that I read, and because I worked in risk management for the investment bank, the top 2 investment banks, I worked for one of them, and I realized that a lot of the methodologies that they were using was really out to date. And it was so odd that you have a risk manager, and when the trader is in red, meaning overexposed, they're trying to help the trader get out of red, and they're investigating. That's very elementary. The reason why today hedge fund managers have grown to what they are, and they will continue to grow in the industry, is because they are capable, not all, but are capable. The ones that aren't capable won't be in business, you see. Again, they are capable of managing their losing trades. And because they are the ones that are capable, how do you analyze whether or not you would want them for your investment is to look at their returns, not using a Sharpe ratio or any of these ratios, or saying that fund did 50%, oh, that's very risky. No, it's not. If the markets allow that particular strategy, and you're not going to know by asking that hedge fund about what their strategy is, you're not going to be able to determine whether or not they're going to do good in a 2020 market or a 2019 or 2022 market, etc. Because a hedge fund manager is not going to tell you what their actual strategy is. That is their private information. And to ask them that question, well, you're opening up a doorway to something very bad, because based on what they say and based on what you're thinking, you could actually select them based on their strategy. But you see, they're not going to tell you their actual strategy. They're going to tell you something, an idea that you're not going to even know what they do, and you're going to be afraid to ask them. So that's why some funds, they do that. For example, when I was completing my PhD, a hedge fund manager came to meet me, and I asked him, what's your strategy? And he said he trades, he told me this very sophisticated strategy, which I had no idea what he was talking about. And then I said to him, so I know that's what you tell clients, but between you and me, what do you actually do? And he said he trades options on the oil market. That was it. It was a simple strategy. And he wasn't going to tell me exactly what he did, because traders are not going to tell you that, because then the investment bank traders could copy it, or anyone that's recording the conversation will go copy it and start a hedge fund. So that's the point, and this is why it's better to have thousands of hedge funds out there trading capital with their own little tweak in their strategy, meaning their exit strategy, because they're managing risk by their exit strategy. And to have all these thousands of funds, investors will have a better selection of hedge funds to select. And this is very, very important, because when you have 10 traders in a group like at the investment bank, and they're all meeting at 5 a.m. to discuss the day-to-day whatever, that's actually very bad. Traders need to be by themselves. They need to have their own creativeness. And yes, trading is an art. Being able to manage your losing trades with a risk management strategy is very important, and it's an art form. You could teach anyone a strategy, and this was something that Richard Dennis said. He said you could teach anyone a strategy, but it's those that are born with talent that will succeed. Whereas his partner said, Bill Eckhart said, he said, you could teach anyone a strategy and anyone could become successful. They were both right. However, the one with talent, you're born with talent. You can't cultivate that. That doesn't happen. Talent in the trading industry is actually managing your emotions. And even though you could actually create an algorithm to trade, there still is someone behind it that's creating that has emotions. And that's why people out there, the traders that are so successful, they're able to manage their emotions. And as I mentioned prior, it's almost like a cop mentality, a soldier mentality, that you can actually control your emotions. And when you learn that, it's very important. But some people are born with a lot of emotion. Some people aren't. Some people are able to control it. I'm not saying that everyone can't. And looking at someone's college education is very elementary, because people who go to Ivy League schools are the best students for the majority, okay? Sometimes your father went there and that's why you get in, or sometimes my friend's father was the dean of the university and so that's why he got in. And my other friend's father, his father put up 20 million, donated to the university, and that's why he got in. So it depends. But for the majority of these students, they have a short-term memory. And a short-term memory is a student that could get 100 like that every time. But that doesn't always mean that that's going to be a successful trader. Now, yes, of course, in Ken Griffin's world, he did go to Harvard and he did become successful. So maybe Ken Griffin has a short-term memory that's expansive, and he probably has long-term memory to memorize and remember his mistakes. And of course, he's probably highly visual because he was able to envision what he wanted to do in his company and propel that company to the $50 billion of AUM that it is today. Whereas Ray Dalio went to my university, which is Long Island University, and he did go to Harvard for his graduate degree. But of course, again, school isn't always an indicator. However, Ray Dalio's company is at 140 billion AUM. So, and of course, he started much prior to Ken Griffin, because Ken Griffin is much younger, and Ken Griffin is in his 50s, whereas Ray Dalio is much older, probably in his 70s. And so, again, looking at education doesn't give you the qualifications to say whether or not this hedge fund manager is going to be successful or that one's not going to be. And so, for example, I understand what talent is. You need to understand what talent is, and if you could pick that out in a hedge fund by looking at their returns, that's all you have is the returns over a minimum of a 5-year period, hoping that they were able to trade through a whole market cycle, which is 8 to 10 years, analyzing their returns. And that's all you could use. So looking at their education is a waste of time. Looking at their prior experience is a waste of time. As I just mentioned, Ray Dalio and Ken Griffin didn't have experience. They just started their fund. And so did Sam Bankman-Fried. Sam Bankman-Fried started his Alameda Research literally as soon as he graduated college. And somehow he was able to raise 14 billion or 30 billion. I don't know the exact number because I get different numbers, but it was a lot in only 2 years. Sam Bankman went to Massachusetts Technology Institute. So that's not Ivy League. Again, it was the fact that Ray Dalio, Ken Griffin, and also Sam Bankman-Fried had that quality to sell their idea. And that's another reason why Anthony Scaramucci invested in Sam Bankman-Fried, because Anthony Scaramucci had mentioned when he was being interviewed, why did you invest in Sam Bankman-Fried? And he said, I liked his personality and I liked his idea and his future ideas. So, again, they had rapport with each other, apparently. But there was a lot of other people that had rapport with Sam Bankman-Fried. Again, I'm not saying that Sam Bankman-Fried was a bad choice or not, but he simply didn't have the management capability of putting people in at the company that were really good managers. And he should have added older people who have 30 years experience, etc., that could take over the management side where he was incapable of. And of course, for investors to invest in Sam Bankman-Fried, already that was a bad idea, because For a trader to start a hedge fund, for me, they need at least 5 years as a hedge fund. But before they started the hedge fund, they would have been trading for 3 to 4 years minimum. And you could take those returns and analyze them, because if you can't use their personality, whether you're going to invest or not, you can't look at their return, you can't look at their education, and you certainly can't use their education. You only have the returns to look at. That's why it's very hard for new hedge fund managers to start out unless they're connected to someone that's a billionaire or a millionaire, or they have family members with a lot of money. It's very hard for them to start. But they have to start somewhere, and that's why you should analyze how much you should be giving them. I would say $1 million to 5 million is really a good way to start. So if they have 5 years experience prior, you could look at their returns and say, okay, possibly, I'm not going to tell you how I do it, but that's what you could do, and then you could fund these guys. But to get up to $1 billion so fast in 2 years is ridiculous. No, that's not possible. And so investors should have never invested in Sam Bankman-Fried, because he didn't have experience trading. He didn't have a track record. As a hedge fund manager, you need a track record. And without these returns, unfortunately, I would never, ever, ever select them for a portfolio. And again, for someone that's a funds of funds manager, you should never, ever have invested in Sam Bankman-Fried or any hedge fund that doesn't have 5 years minimum experience trading as a hedge fund manager. Of course, they're going to have experience prior 3 to 4 years. And you could actually deduct that. It could be shorter if there's a year that the market collapses, such as 2008, 2009, 2020, and so forth. And so it's just, the whole industry has to change how investors look at hedge funds and how they select them for their portfolio. Again, just because you're a billionaire and you have money to invest and you have to invest it, you need to be very careful, and you need to study everything that I know on how to do that. Thank you so much for watching my video. Please remember to subscribe to my channel and do thumbs up. It's right there. It doesn't hurt. And please subscribe to my channel so that my channel grows and it prospers. Thank you so much.